Hey, Joe Shu here, founder of Crypto Consulting Institute. I'm really excited to bring this webinar to you with the Charles Edwards of Capriolo Investments. Now, a lot of you would have already heard of Charles, but if you haven't, you would have seen his work from the over 200 on-chain data models that he has built and is responsible for, which absolutely have a pivotal impact on the decision-making process when you're building out your investment strategies, but more importantly, identifying market tops and bottoms. So in this session, Charles will pull back the curtain on exactly this, what he's looking at right now. Where are we in this cycle? Is it a super cycle? Are we at the top of the cycle? And also he will share his insights on quantum computing's and the impacts that this may have on the Bitcoin and crypto space as a whole. So I look forward to joining you on the inside of the webinar now.
This picture says a lot to me. It's just the orange, obviously the orange lines are greater than 100 million cells or technically transfers.
Yeah.
And the red is 500, right? And this is for all what I call OGs, so 7-year plus holdings. And that's something, a metric I've been tracking for at least 5-6 years. Because I often look at it just Bitcoin transfers, but I've just visualized it here as dollars because it's a bit easier to see the impact. People say, oh, it's not as relevant because obviously Bitcoin's worth more now and dollars is not a fair metric. But I've also plotted this in our latest newsletter as a percentage of market cap, and it also shows the exact same thing. Really strong, like large, significant portions of market cap being unloaded in the last 12 months. And you can see a pretty strong correlation to that kind of transfer of assets happening at both market tops and also some capitulations at lows. But typically it's a much higher frequency of selling at highs. So this is mostly smart money. And just a massive concentration of transfer coins in the last 12 months. Obviously, you can argue some of that is, as we touched on before, transferring to ETFs or different wallets and that sort of thing. But I think largely that's not the case because these guys don't move their coins much. And you can see, as I said, it's a high concentration of transfers at market tops. And it kind of confirms the conversations I've been having with people on just different chats that have been in this space for 5, 6, 7+ years. And a lot of them have been reducing crypto holdings. So I think, there's definitely a bit of cashing out happening in this cycle, and it lines up with what all the OG sort of Bitcoin people would view as the end of the halving cycle year. I'm not necessarily a believer in the halving cycle kind of being a continuing factor, but the psychology and behavior of the participants also drives that, and we're seeing that happening this year.
Yeah, it's definitely an interesting time of market with the halving cycle. I don't actually have the metric on that.
I heard, just to pick your brain as well and just add something, I heard Jordi Visser, he did a great post on Substack around how this is Bitcoin's IPO moment. And
I find that a joke, to be honest.
Yeah, you find that a joke. I find that there's lots of different narratives spinning around the place, and you can make up whatever you want. But to me, this just feels like maturation in Bitcoin's progress as it matures into this macro asset. And you've got all these OGs selling for a variety of reasons, but it's distributing the larger wallets to smaller wallets. And I just think this is how Bitcoin's going to run. If we want these higher prices, we want this asset class to continue moving higher and just getting bigger. We're going to see different things happen, and this 4-year cycle is now a bit of a meme. That's my thinking, that the miners aren't having this outsized say. Well, maybe I don't know that for sure. I mean, this could be a lot of Chinese whale selling, potentially moving into their AI sectors and their hot stock markets. So there could be a bit of that, but I think we're on uncharted waters here, and it's going to be fascinating to see how it plays out in 2026, where I think there are some serious macro tailwinds coming.
Yeah, there's definitely a few dynamics at play. Like all these guys obviously super wealthy that are unloading, so it kind of makes sense to diversify at some point. Buy houses, whatever they're doing with their lifestyle, right? So there's some of that, but I think it's also the relative return opportunity. I think crypto obviously has been the best returning asset class last decade. You can add NVIDIA to that, obviously, but otherwise it's been the outstanding play. And that opportunity and upside is definitely less now that it's a $4 trillion asset class, because you just can't get the same level of returns on an asset class that big. At the same time, you've had other asset classes like equities this year in particular outperforming with the AI boom and gold and that sort of thing. So I think there's definitely diversification happening, as well as the people acknowledging the upside is a bit less, as well as other risk factors like quantum, and then you've got the end of cycle narrative. Whether it's true or not doesn't really matter for a lot of these players. So it kind of makes sense that there's a bit of a tapering, I think, of allocation of smart money in the space.
Yeah, it makes logical sense. If something or a number of other assets are showing outperformance in this year, which happens to be historically a topping year, then naturally it makes sense that people are looking to hedge some of that risk. And I guess the guys that have held for 7 years have probably round tripped a few times as well, and they don't want to be in that position again. So they're front running the potential of it anyway. What do you see then around the liquidity cycle, where we're at in that cycle, the tightening regime, which now seems to be a neutral, almost entering a potential easing phase? Where are we at, and what impact do you think that may have over the next 6 to 12 months in Bitcoin in particular, let's say?
I hope you're enjoying the webinar with Charles, Sammy, and myself. I wanted to jump in with a very quick opportunity to help you take control of your financial future. Now, for most people, when they step into the crypto realms, they are gambling. They are gambling because they listen to information from other people. They invest, buy and sell when they hope is right, and they don't have clear strategies, data sets, risk management, most importantly, in place, and they're buying a ton of altcoins that go to zero, unfortunately, or underperform against Bitcoin, certainly as of late and in this cycle. There's been a drastic divergence of expectations of what people thought might happen and what has happened, and that's led people to force bad decisions over and over again because they don't have the systems, the processes, the data in place. So at CCI, we've helped and empowered over 3,000 clients now across our team with 71 years experience, and we've actually created life-changing results. And I don't know any other crypto education company out there that can boast the actual financial returns that our clients are getting. So if you want to transition away from having no strategy, making poor investment decisions and not understanding risk, emotionally investing and chasing trends and hype tokens that most people do because people on YouTube are shilling that, and not actually having control of storing your assets in the right way, and most importantly, understanding the future, then this is an opportunity for you to learn more about our VIP immersion program. You can book a call in with the team on the side. You just click the link and have a one-to-one discussion with them, where they'll learn more about you, what's driving you, the goals that you're trying to achieve, what's possible, but more importantly, give you system strategies and ideas about the current market conditions. And then if it aligns, we can share the opportunity of what it looks like to come on board and work with us. And maybe you can become one of our next $1 million clients, but certainly get to the level of achieving some incredible outcomes and joining all these amazing people. We're the top rated crypto education provider on Trustpilot, and 97% 5-star rating with over 200 reviews now. So here is an opportunity of a lifetime for you to take control and really understand how to position yourself for decades to come and create generational wealth, rather than listening to friends or listening to people on YouTube. It's about understanding things for yourself, so you have to listen to no one. That's true freedom, that's true empowerment, and that is exactly what we do here at CCI. All right, take care, guys. Enjoy the rest of the webinar.
Yeah, so can I share screen?
You should be able to.
Yeah, so but just broadly, like liquidity globally, obviously is really positive. That's what a lot of people have been talking about.
Is that one of the main metrics that you look at? And
yeah, so this metric here called net liquidity, it's basically just the year-on-year change in money supply, but less the 10-year Treasury rates. So I like that as a bit of a gauge of, the growth in money supply netted off by the cost of capital. So every time it's been green, Bitcoin's had its major bull runs. So that's definitely a positive sort of backstop. You can also just take out the cost of debt and look at the year-on-year change in money supply, which is obviously very easy to understand. It's going up about 7% a year, which is a lot. So still incredibly strong inflationary forces in the market. all of Bitcoin's bear markets happen when that value is low or negative. So that's definitely a strong force for Bitcoin and hard assets like gold. Countering that in the last few months has been US liquidity. So this metric is tracking just the kind of the initial forces behind money supply, if you will, or liquidity in the US. Which we've got some descriptions here even, but it's the Fed balance sheet, reverse repos, and Treasury general account. So basically, as soon as the government puts money in these different accounts, it often then flows into capital markets. So that's kind of a gauge for US liquidity. It's been coming down since August, and it's really like plummeted since the US shutdown, which is just finished, but it's been over 5-6 weeks. So that's been a constraint in the markets. I think that's also held Bitcoin up in the last 5-6 weeks. Really, the shutdown. Markets tend to kind of do really strongly out of the shutdown, so there could be a bit of a boost from this now as capital's kind of unlocked. But yeah, generally speaking, as long as global money supply is positive, provided US liquidity isn't really in a downtrend, that's really strong for the market. The only kind of the main consideration outside of that is what's the forward-looking situation, because that's what the market will be discounting. And obviously, the Fed has said that they will be in their dot plot. They're forecasting to cut rates by about 1% the next 18 months. So that's pretty much the consensus average across all the Fed members. So we can kind of expect, easier money. That also plays into net liquidity, right? The rates will come down, so net liquidity will go up. On top of that, we have the Fed has basically said they will be purchasing assets. Wrote about this in our latest newsletter, but they've written that they have to at some point start buying assets to grow their balance sheet to be a relevant participant in the market. Otherwise, if the Fed's balance sheet gets too small, they can't influence the market forces enough effectively. So they've said that at some point soon they do need to just buy. So we know there's going to be buying liquidity soon, and we know that rates are coming down. So there's a lot of positive drivers for liquidity to go up, and of course all the other factors like really high debt globally, they just have to kind of print anyway. So all of those things should be really positive for hard assets like Bitcoin, gold. Obviously, gold's been flying this year. Bitcoin's kind of lagged a lot, and typically Bitcoin would catch up on that. I think there's a couple of reasons Bitcoin's continued to lag, and it's firstly the end of cycle and OG kind of selling behavior, but also I think it's the growing risk factors of quantum.
I was going to ask you about that with quantum, whether you saw some of that selling into that. That's very interesting.
I've got the tweet open. We follow all the tweets. So yeah, but tell us a bit more around this. You've put a countdown clock here on this, which is really interesting. And from what I do understand, there's some inbuilt within Bitcoin on maybe some of the layers, and you can probably explain this a lot better than what I could. But is Bitcoin not to some extent quantum resistance already, or not at all?
Yeah. So firstly, this is not my clock. I just found this and thought it was really interesting.
Okay. Throwing out the disclaimer.
And the timeline, this is an aggressive timeline, but it's not also that unrealistic. The kind of front edge horizon risk for quantum breaking Bitcoin's elliptic curve cryptography is about 2 years, so less than this. That's really aggressive. And the kind of the slowest horizon is really sort of 8-9 years. If you survey kind of where the industry is at, public companies are at with their qubit rates, their error rates, and where the logical qubits will be in sort of 4 or 5 years, we're looking at a higher probability in that sort of 4 or 5 year range, and some probability in sort of 2-3 range. But to answer your question, Bitcoin is one of, if not the most vulnerable assets in the world to this, for 2 reasons. Firstly, is a lost coins. So there's about 20-30% coins, Satoshi's wallets, other coin wallets, and anything which was using an early Bitcoin wallet hashings. It's called P2P-K, which basically means that the public address of the the transacting wallet is on chain, is just visible on chain. So basically any public keys that are exposed, or if you even some of the biggest crypto exchanges, right, like Binance and that, you can track their public wallets. They're less risk because they'll probably migrate to some kind of quantum proof fork or what have you in the future. But the ones that don't migrate, the lost coins, the early wallets, there's about 20-30% of assets in that. A quantum machine will break those. So you can they can basically back calculate the private key from the public key when you've got about 2,300 qubits. And that's forecast to happen across 5 or 6 of the biggest quantum companies in the next 4 or 5 years. And they're all kind of historically been beating their own forecasts. So there's very high risk of that in 4 or 5 years. So that means that 20-30% of coins will be taken by basically a quantum hacker in that time frame, probably earlier because we're not even talking about China here, and they're spending double the US on quantum every year. So they've got some of the Chinese quantum companies are well more advanced than the US ones. I think the US is going to pump more money into it as well because you have to be competitive on this. It's not just about Bitcoin; it's about innovation and secrets and code cracking, all that sort of stuff. So this asset class quantum is progressing really aggressively. If you can track the qubit rates over time and it's linear on a log chart, it's progressing faster than Moore's law. So we've seen for 100 years transistors double in capacity every 2 years, quantum's doubling every 18 months. So there's a big risk coming to those coins. They will be taken. And so there's 2 options there for those 20-30% of coins. Is, do we as a network just let them be taken, and then we'll see 20-30% of supply dumped on the market, I would expect within 6 to 12 months? Or do we kind of come to some kind of consensus and effectively burn those coins or consider them untransactable if they don't migrate to a quantum proof sort of hashing algorithm within a deadline of, say, 1-2 years? That's one of the big challenges the kind of Bitcoin network needs to come to consensus on the next 2-3 years. And the other is migrating all of the active coins. So the remaining 70-80% of coins, like us, people with active wallets, we need to migrate to a quantum proof variant of the network where public keys are not visible, not accessible, where even if you reuse them, they're not at risk, with stronger encryption, basically. So there's some proposals out there to support that process. It's technically achievable, but there's big challenges that need to be overcome, including increasing block size, etc., which historically has been a major sticking point and fighting point for Bitcoin, where it's a very slow network to upgrade and just people don't want to make these huge changes. So this is one of those times where survival of the fittest is about adaptation, not strength. So Bitcoin is very slow at adapting, and we need to really speed that up.
Interesting, because I remember being in Melbourne. I used to go to the blockchain center in the early days and having the debates around Bitcoin and Bitcoin Cash
Yeah.
when that first happened. And it kind of feels like we're proceeding towards a very similar moment to that. Where
That whole that was as you know, there was a massive online sort of battle, which it took forever to get any kind of movement on. And this is a much more significant change that needs to be made as well.
Mm-hmm.
Or the network's in a lot of trouble. A lot of people say, oh, well, if Bitcoin's in trouble, then all of banking and the internet's in trouble. And that's just not true because of a few reasons. But banking, a lot of these centralized institutions have already started upgrading to quantum proof algorithms. Being centralized, they can also, if there's a hack, they can reimburse or cancel funds, all that sort of thing, wind back things back that crypto can't do. But most importantly is just basic 2FA. So most platforms, banks use 2FA now, and that is basically by definition quantum resistant because you only get a couple attempts to guess it. So a quantum machine can't cycle through every infinite opportunity of 2FA code to break it. So if you've got good 2FA and strong passwords, and they're already migrating to quantum proof algorithms anyway, then these networks are totally fine. And on top of that, the traditional sort of platforms and institutions use RSA, which is much stronger than Bitcoin's elliptic curve cryptography. So even when it does break, it's kind of like years later than Bitcoin.
Yeah, very, very interesting. And obviously there's people talking about this, but it's not in the right in front of you, kind of mainstream anywhere yet.
And that's the problem is like while the threat is not, relatively it's low today, but we, as you mentioned, the Bitcoin Cash stuff, like we know any change in this space of significance is going to take years, and we haven't even agreed a technical solution. So I think that's why I often keep saying 2026, like we need a technical solution agreed in 2026, because I know that even once it's broadly agreed, just getting that across the line and deploying it is going to take at least a year. So if the front edge risk is in 2 years, for me, we need to solve it and have some broad agreement 2026 to then deploy it and have a chance of kind of being on the front foot, because you just can't afford to be 1 minute late, right? Like if you're 1 minute late, all trust in the network collapses.
Yeah.
So I'm optimistic we'll solve it, but this is like obviously a growing risk, and I think people, they don't talk about it necessarily publicly, but they do talk about it privately, and you see it in also the ETF disclaimers. It popped up that quantum is a risk, and it wasn't there 6-12 months ago. So it's just something that really needs to be addressed, because obviously people take action privately, and they might move coins. That it might be partly the OGs kind of cashing out or diversifying more, because they see it, even if it's a small risk, it's just you can't have that small risk. It's something. This asset class is built on trust and hard money, and it's not a hard money if there's a risk like this on the horizon.
Well,
so
it's existential, isn't it?
Yeah, and if 20-30% of supply hits a market because some Chinese quantum company has just taken all the coins and unloaded it, like the whole hard money thesis is gone. So yeah, we need to solve this in 2026.
And obviously it's an open source network, so it means that there's going to have to be developers doing it for that free will. They're not going to earn money through any way of doing this. So how do you motivate people to actually step up and take the action to do that?
Yeah, so that is partly the tough part, but a lot of people working on Bitcoin have significant investment in it, so there's incentives there. There are a couple of Bitcoin improvement proposals, BIPs, to solve or work on solving the quantum solution. The trouble I have with it is it's not really a clear and centralized way to engage the community to agree and move forward on that. It's just kind of chaotic, I think, on Twitter.
Got their ideas.
Like there used to be back in the day, the Bitcoin forum. Maybe we need to reinvigorate that. Maybe we need to have some roundtables with miners and some of the Bitcoin developers. Because I've gotten really vocal on this in the last 3-4 months, and will continue to be. I'm just trying to spread the word to get some engagement and some action happening from people. But I've been having these kind of chats a bit, and it's really clear that even people who've been in the space for a long time, it's not a really clear pathway to to getting agreement on solutions, and there's a lot of time being wasted on JPEGs on chain and other Bitcoin development things, which really just not important at all at this stage. So that's something we probably should be focusing the conversation on now, is how do we concentrate efforts on agreement on different solutions.
It's funny, I said that to Jamie Coots, that you seem like a lone voice in the wilderness on X, and you were just like, most of your tweets is like, guys, quantum is a big deal. And thankfully you do that, because it wasn't front and center in my mind, and I had to educate myself. I'm like, oh, okay, this is very, very serious. But what fascinated me more was probably what you're experiencing is you post this stuff and then you read the comments. And people are, you're just getting a lot of negative pushback and all this kind of stuff. Like,
yeah,
all right.
To be honest, it's kind of painful. I think there's a few things. Like, it's really surprising. Like to as you guys know, to find Bitcoin, discover it, and then believe in it as investment, you have to really think like outside the box, right? In the first instance, you have to read about it. You have to be like, oh, this is decentralized money. It's hard, and that process takes many, many hours and, outside the box thinking. But then the ironic thing I've found is that so many of the OG Bitcoiners who just only believe in Bitcoin, they won't touch altcoins or anything like that, right? They just find the concept of changing Bitcoin to survive the next decade, like a total no-go, or like they just think it's crazy or it'll never happen. Like, so that it's just ironic that they can't have that same kind of take the blinkers off approach and think about it. Um, and the amount of like anger out there about quantum is really also a big obstacle to get over to actually upgrade the network. Like if you can't have an educated conversation about it without instantly dismissing it, which 60-70% of people just dismiss it as crazy without having any research or thought process on it. um, yeah, it's a bit concerning because we need to get through that phase to get some change happening.
I think a lot of people have trouble processing risk.
I think it's also some people are just tied to their bags and they want Bitcoin to just go through the roof. And if there's this dude like complaining about quantum risk, it's not going to maybe go through the roof as quickly. Like
you often think of Bitcoin as like, it's the sure thing, but you always, as an investor, and again, I personally own other things outside of crypto and Bitcoin, is you still have to think to yourself, it's not 100% guaranteed to continue moving higher and to succeed, and nothing's ever going to happen. There's risks of code breaks. There's 51% attacks, all that kind of stuff. Like it's a non-zero percentage chance, and quantum is the biggest threat vector, in my view. It's really soon and relevant. We all got to be across it, and like you said, around the big funds are now educating their clients, like, guys, this is now a non-zero percentage risk to your bags if you're buying ETFs, etc. Which it's a big deal, and it will keep flows potentially cautious going forward. And unless there is and even if there is a solution, like you said, there's chaos and there's a bit of confusion, and there has to be consensus. There may not be consensus. There might be confusion with the forks. People will refuse to upgrade. So. Just like we saw with Bitcoin Cash and other things, there was, if I remember correctly, I wasn't quite heavy in the space at the time, but the people like Raoul Paul, just off the top of my head, he sold his entire Bitcoin bags because he was just for the risk that it was forking and he didn't know which one was going to be the chosen chain, etc. There would be a lot of people that are like that. They'll sit back, they'll let the dust settle, and they'll buy the carnage depending on which chain succeeds.
And that's a great point. Like you don't know. There'll be multiple solutions. You don't know which one will win, and they'll be de-risking. And I think you see all the markets are forward-looking, like equities markets. They're pricing the next 12, 24 months. And I think this, obviously, crypto is definitely an institutional asset class now, and there is a lot of forward-looking pricing. And people are thinking about these risks. They're thinking about the de-risking that might happen in 12, 24 months, and that's impacting their activity today. And the ironic thing is, this is not really a risk for gold. So this actually makes gold's value prop as hard money better in the short term than Bitcoin, which is kind of crazy for me to say because I always thought of Bitcoin as a better hard money, a better store of value. But the time horizon of this threat is closing, and until we have agreed a solution, it does make gold stand out.
Yeah, I think that's when I always like to throw out the asteroid mining, but that's further away than quantum.
Exactly. Yeah, and they even like like those things probably come, but when is it? 10, 20, 30 years? And also when it does come, is it going to be as cost effective to, the pricing of it will probably be so extreme, at least in the near term, that yeah. So, and even if even if that risk was tomorrow, it doesn't justify, no action on Bitcoin because it's a necessary thing to solve.
Probably at a minimum, even if the quantum thing is solved, you're still going to get Satoshi's coins coming back on the market anyway, and all these old lost wallets. So there's going to be a massive supply unlock, which, like you say, markets are forward looking. They'll try and price that in, but how do you price? You won't know when it gets hacked until the coins hit. And you're like, those wallets are moving, and you're like, oh shit,
and all the Bitcoin maxis, you'd be like, oh, it's Satoshi's back, quantum
let's buy it. Satoshi.
He's going to save us, and then they'll just get sent to an exchange and just market sold.
It's all right, mate. OTC doesn't move the market.
So on the bearish sentiment that we have going, let's jump in and have a look at this, because I know that this is obviously quite a significant thing to see. It was in the beginning stages of the ETFs, or institutional buying, it was constant of hey, we're producing X amount of Bitcoin a day, but the purchasing is like 10, 20, 30, sometimes far greater than what's actually being produced every day. So what do you see with this? Is it again just lining up to the bearish sentiment? Not necessarily, I don't know how much the quantum side of things is having an impact on this. I think it's more the price action and then outperformance of other assets. But what do you see with this, mate?
Yeah, well, let me share because I got a more up-to-date
Yeah,
version.
please.
um, wrong share.
All good. I was actually going to ask you as well when you were in the screen earlier. It's like when we were on with Jamie, I'm always a kid in a candy shop. It's like, what's some of the main
Yeah,
metrics that you're looking at in here as well?
yeah, yeah.
Um, yeah, that
Um,
constantly
yeah, I
check.
didn't even think about clearing out all the tabs and things.
Oh, you're all right.
Could have been much worse.
So yeah, so this is the latest version of the chart. So for people who don't know it, the total or the blue line is the institutional buying per day as a percentage of market cap. So it's had some huge waves recently. And then the red line is the Bitcoin mined per day as supply. So every time blue is above red, which is this green oscillator here, then you have buying activity by institutions, which outweighs the supply available that's coming into the network. So that's really bullish. You can zoom out and see that every time it's been green, which is the delta here, price has just gone through the roof in the last sort of 6-7 years. We went from 40 to 80K back in April last year. We went from sort of 60 to 110K, whatever it was. So, all the big pumps have happened on the back of institutional buying. The problem is that in the last months, we've gone net negative. So the institutions are selling over 200% of the mined supply. So you kind of think of that as Bitcoin's mined supply being 3 times higher than normal if you just, net that all off. So that's not good. And that when that crossed zero, like it tweeted about, and the tweet you showed, it was about 110 when I shared that tweet around here.
Yeah.
That for me was an instant like de-risk signal. So
Yep.
we actually went net short from there. But I think there's some positive things happening as I tweeted about yesterday morning and wrote about the newsletter that kind of may see this shift back up, but to be seen. I want to see this kind of gap close in the next week or two. If this kind of stays negative for a long time, that's definitely not going to be good. All the bear markets and that sort of thing happen in that background, and we've just seen in the last 2 years that all of the positive price action behavior has been led by strong institutional buying. So I just don't want to be offside on this. Obviously it can flip at any point in time. Price could be higher when it flips, but for sort of sustained trends, we definitely want to see this come back. So I'm not really, I'm neutral to the idea of Bitcoin cycle. I'm not really a believer in the mining behavior driving that into the future, as we touched on earlier. But this for me is a key factor of where the macro trends will be. Obviously, liquidity and those other factors. But if institutions are not net buying this asset class, I don't see us trending long term. So for me, the whole cycle sort of macro trend for Bitcoin outlook is very dynamic, and it depends on liquidity, but it probably depends on this more. Are institutions active? Are they buying?
Yeah.
What do you think?
Go on, Joe.
I was just going to ask, what do you think has led to such an extremity of downturn from where we recently were?
I
And
think
anything outside of what we've already mentioned?
Yeah, so one thing that'll be really good to see I think in 2 to 3 weeks, we'll have a lot more clarity because we just had the shutdown for 6 weeks, 5-6 weeks in the US. We just saw as we went through, the US liquidity dropped. That means less capital available into TradFi markets, and there's just de-risking broadly. Like the S&P was de-risked a bit, credit spreads went up, so there's de-risking behavior in the bond market as well, and then also Bitcoin went down and Treasury institutions were unloading ETFs as well. So I think there's a lot of de-risking because no one really knew for certain how long the shutdown would go, how long liquidity would be tight. What we do know is that in prior shutdowns, markets really rally strongly out of that because the liquidity is unlocked. There's more certainty. Markets in general obviously de-risk when there's less certainty. So I think we'll know in sort of 3-4 weeks if the markets continue up with strength, we could see institutions step back in with with force potentially, and that picture could be green, right, in 2-3 weeks time. But I'd like to kind of wait till that point. Like if we haven't moved by, call it, first week of December into positive territory, I'd be pretty worried about the outlook for Bitcoin in the next few months. Already now, I think as long as it's negative, it warrants some less risk taking, some risk off behavior. But if it's not kind of growing out of the sort of the wave that comes out of the post-US shutdown, then we've got some deeper concerns. So I think that's one of the driving factors is the shutdown, but it's also the other factors we already talked about, some growing risk factors for Bitcoin, but also just the broader underperformance versus equities and gold. Yeah, you just plot the gold chart the last 2 years; it's almost a straight line, and then you compare it to Bitcoin, and it's pretty embarrassing. So, we'll see. I'm optimistic. There's a lot of also headway for if institutions do step back in, liquidity starts expanding in the US. I can see Bitcoin at 150, 180K very quickly because we're deeply discounted to some on-chain values like energy value, like NVT, also in the green zone. So this can move like really rapidly and aggressively to the upside, but we definitely need institutional support for that.
I just wanted to say as well, the data that you're sharing is just phenomenal. I love it. A kid in a candy store, like Joe said. But what I was interested when I look at that chart, it's similar to what I look at the ETF inflows and outflows. I look at far side investors, so not as fancy as what you have there. But I look at sustained, concentrated outflows or inflows, and then I'm looking at sentiment. So I'm kind of overlaying a few different metrics on top, and I was just seeing the sentiment is apocalyptic. Like honestly, it's terrible. And
Yeah.
you've got these sustained outflows, not record outflows, but you've got that really, really strong outflows. And I saw on your chart, you pass that minor point, you go underneath. It's almost like a capitulation of sentiment of those short-term holders of, long-term whales. And we're holding above 100K, and I'm just looking at that going, it's probably a pretty good spot to start looking up because, and it's a small sample size. If you go to your chart, you can see, we're in a relatively new regime with the ETFs and this sort of modern Bitcoin, whatever it is and where it goes. So you kind of take it from maybe the FTX low to where we are now from the ETFs, let's say. But yeah, I look at that almost like, all right, we're finding a nice equilibrium here. Buyers and sellers are kind of feeling that price point out. If these institutions kick back up, that's a really strong place to be. So yeah, I kind of look at the other side like you as well.
Yeah, that's right. You have to kind of trade off all these kind of metrics with, okay, if they're trending down, it's bad, but at some point, if they're negative, it's prime for a mean reversion. So if the bull market's intact, if liquidity into this asset class is really strong in the coming 3-6 months, which we think it quite well could be, then these can be really great dip buying opportunities. And it's like also the hash ribbons, right? The best opportunity to buy hash ribbons is not actually when the signal goes up, it's when you're in the capitulation. But the problem is you don't know how long the capitulation will go. It could be a week, it could be a year, right? So that's why while the opportunity is greatest when institutions are maybe selling, we don't know if it's going to be a week and then it's over, or what if it's a year and a half, right? Like so. Yeah. So yeah, there's obviously there can be more risk with it, but there's also can be the greatest opportunities in those spaces as well.
Are there any other data sets or metrics that you tend to look at quite regularly to help with your investment decisions?
Yeah, so I can just share screen and flick through a couple, but like I'm looking at our own platform every day. So
Yeah.
basically built this to help visualize a lot of the metrics that I really like. But there's still a lot more we use, and we're still adding more all the time. But I'm most interested in sort of a top-down approach to crypto. So macro being one of the drivers. Also, we touch on liquidity and that sort of thing. Strength in equities is also really important. So there's a number of metrics to cut that, but advanced decline line's a good one. We actually failed to break out recently, which technically isn't good for that metric, but there are other metrics that look good. For example, the put call ratio in equities is actually really useful for Bitcoin. So for those who don't know, it's basically the net sort of positioning in the options market. And if there's a high amount of puts, it means people are kind of cautious, and we've inverted it here so that when it's low, there's a lot of puts. And so if it's near the green line, it's bullish. So basically when people hedge a lot, usually the market is near a bottoming phase, and you'll see a lot of the kind of lows, or at least local lows, if I just put my mouse over, are when this is in a sort of deep risk off behavior. So we're pretty much at a big extreme there recently. So that was quite bullish. I tweeted about. It also plays well with Bitcoin. Then on the Bitcoin side, there's on-chain metrics here, and also derivatives market metrics. I like this one, for example. This nets off all of the futures markets, so perps, options, and fixed futures. And weights them by market cap to find when they're at relative extremes. So for perps, for example, looks at funding rates to see if the market's offside. It's basically looking for, like put call ratio, looking for positioning that's offside or skewed in one direction. So when people are really bullish, tends to be a market top, or at least a higher risk of it. And then when people are very bearish, it tends to be a low. So, we're kind of in a middle ground area here. We had a local low a few weeks back, and then the market rallied, and then we kind of normalized. And there's not too much to say at this point, but whenever this is an extreme, it's quite a good metric for at least the coming couple of weeks. Some of the on-chain ones I was talking about before is MVT. This is a really classic metric that doesn't get talked about much anymore, but is still really quite good, I think. All these metrics, you can't expect a perfect hit rate, but it's about aggregating them up and getting a holistic view. But this is looking at the network value to transaction value. So it's basically market cap to transaction value through on-chain data on Bitcoin. And then we take a sort of Bollinger Band dynamic approach to find when it's relatively high or low. It's in a deep value zone right now. And then on top of that, it's pretty consistent across a number of these metrics. Energy values at 175K. This is dynamic. It can come down if miners start shutting down and that sort of thing. But we're in a very green zone right now, which typically means deep value opportunity. So this sort of stuff for me means that if we can get those flows back in the macro side, if we can get institutions step back in, Bitcoin can move really fast to the upside and kind of close that lagged gap it's had behind gold and every other asset class within a couple of months. But you need to see that macro alignment. And given a lot of the capital flows now are driven by the ETFs and treasury companies, you need to see that as well. We haven't even talked about the treasury companies, right? But they're obviously in a terrible place as well right now. The MNav, which is this light blue line here, is this is the percentage of treasury companies with the MNav less than 1 is at 32%, which is pretty bad. Like the institutional net selling, you can say that the best opportunities are when that is high, right? You get dips and that goes high, but at some point, I think that business model breaks down. I don't know if we're at that point yet, but we've got 188 treasury companies.
Sailor filled his bags, and then now he's going to exit.
I was going to say, if these treasury companies can't raise more capital, then their business model is kind of shot.
Yeah, and you can exactly. And
what happens then to the Bitcoin?
Yeah, this chart looks terrible.
Right? They might have to offload it.
Sorry?
Yeah, that's what I mean. The guys would have to start offloading, surely.
The first point is so that when the kind of the dynamic process for it is like when there's tons of interest of it, you get more and more treasury companies launching. They got capital flowing in, and their MNav, which is the value of their the companies the Bitcoin explodes above 1, which means that people are willing to pay more to get on that growth cycle with the assumption that they're going to use, leverage, debt, equity, whatever, to get more Bitcoin and have a Bitcoin yield. That narrative obviously then goes backwards when there's less interest, people buy the assets less, the MNav collapses. And then when the MNav is less than 1, so we've got mean MNav here, which is almost at an all-time low. yeah. So there's two MNavs here. I'll explain. Normal MNav is just the value of the company to its Bitcoin as a market cap. MNav Enterprise also includes all the debt and cash in the company to give you a bigger picture. But both are useful. I think the market cap one is probably more used by participants, but either way, it's at an all-time low. And yeah, that just means that the more companies with MNav less than one, they can't issue equity to raise capital because it's dilutive. It's bad for their shareholders, so they have to use debt. So basically, the bigger this number grows, MNav percent less than one, the more these companies are incentivized to use leverage, because the only way they're going to keep their shareholders happy and grow their share price is if they have a positive Bitcoin yield. And now the only way they can do that is using debt. So
they get rinsed in the deleveraging event.
Yeah, so the other option is you're bought and you sell your holdings, which we've seen quite a bit of in the last month. A few companies have sold half their treasury holdings to try and close the gap, and it just makes it worse. Or you can take on leverage and risk everything, but you can stand out amongst the herd, right? So I think we're going to start seeing more of that. You can track the debt ratios here. It's still at relatively healthy levels on the most part in terms of debt to enterprise value, but you can see it is climbing, and debt to Bitcoin holdings is climbing. So it's not, if this was above 50, if they were above 50% or even, higher, then I'd be pretty deeply concerned. But yeah, it's definitely something to monitor. You can see the net impact then flows through. So less buying, lower MNavs, and that means the company's buying per day is dropping. We're just seeing this plunge again. It looks like a bit of a double top situation here. We'll see.
Short it.
Yeah. The buy sell ratio had been basically a straight line up for 18 months. It's still pretty strong. So that's not too concerning yet. So there's not a lot of companies selling yet, but
Okay.
yeah, those metrics, when they start turning to net sellers, that'll be pretty concerning. So there's still a lot of strong buying behavior. They're sticking to their business model. They're trying, but we'll see where it goes from here. Yeah.
I was going to say, do you have accurate data on here showing you the exact amount that's being offloaded, or like,
yeah, this is all these metrics. This is tracking everything live daily for every buy sell of all the companies.
Gotcha.
And you can even dive in and look at each individual company here.
Right. That's amazing.
Yeah, I was going to say, you built all these models yourself, did you?
With the team, yeah. So
really impressive.
So this is just MicroStrategy. We can, if we want to talk about it, or we can.
Yeah, no, we had a whole section here. We'd love to pick your brain about treasury companies and MicroStrategy.
Yeah, so I mean, I haven't looked at this recently, but how much is MicroStrategy down? 60%. So yeah, we track all the metrics by each one. So the Bitcoin yield for MicroStrategy has just collapsed. You can see this green line here. Their whole business model is, we generate yield on Bitcoin, right? Is it the lowest ever?
Yeah, it's
or near the lowest. I think that is the lowest since literally the lowest since 2021. So I didn't even know that till this call. So yeah, their whole business model is pretty bad right now. Because why would you invest in them if you're not getting any yield? That's the whole point of paying more for their asset. And so you don't. And so the MNav collapses. So the MNav was 2. People were paying double for MicroStrategy than they were for Bitcoin. And now it's at, 1.1 to 1.2, depending if you use enterprise or not. And it's been negative before. People don't realize that. It was negative in the bear market. So that, it doesn't have to kill a business. I think if anyone's going to survive, it'll be MicroStrategy, simply because you've got Michael Saylor and his unwavering conviction in the process. But the problem I have is there's a place for some of these companies, but I don't think there's a place for 188 of them, because if you've got, whatever it is, 60 or 80 different publicly listed treasury companies in the US, like, why would I invest in yours versus the other 79? Like, most of them don't have any value prop. So yeah, we track all these stats by each company. You can dive in and kind of analyze each one on the platform.
Yeah, nice. Awesome. Sammy, any other questions that you got for Charles before we wrap out the session, mate?
Look, it was more around the treasury companies, but I think you've covered that all. We had some clients that asked a couple
Yeah.
of questions here. Yeah, look, you covered Bitcoin treasuries have stopped buying. I saw some were down 90%, like Nakamoto and others, which is very disappointing if you aped into those. Yeah, I think you covered it all. We were curious whether there was a forced dump happening in the data, and you're saying that they're starting to offload, but we haven't really. We're going to have to wait for more data
Yeah.
to come out to see if it really
So
that MNav going.
that's it. The positive thing is they're not a lot of selling on aggregate, right? There's not yet a lot of selling, so they're holding ground, so to speak. But their business models are like increasingly under threat. So if Bitcoin rallies to 120, 130K by the end of the year, which is possible, it could even go higher, then probably a lot of these companies will rally as well. And then people forget the whole risk factor. Probably you'll see more launch. You might get over 200, 300 treasury companies, right, in a year's time. I'm just saying, I think whenever the trend does shift for a significant period of months, which could be now, but it could be next year. It's going to happen at some point, as we know in this market. It always does happen. I think there's going to be a lot of these a lot of these companies that just collapse.
Yeah, it's probably a lack of volatility too, isn't it? The market needs some kind of volatility. It's kind of a weird situation. We're in this sort of time-based chop capitulation, maybe for longer than most people expected. So there's this capitulation of a lot of these big holders. But if you're owning any of these companies and you're seeing you buy the stock because you want to outperform the base asset. Otherwise, you're better off just buying Bitcoin. So yeah, like you, I think MicroStrategy is still the smartest and safest play, even though right now it doesn't really look like it is the safest play or smartest play. But out of all of them, yeah,
Yeah.
you'll probably see a lot more dumps on the market.
Yeah. And my concern, I think if we have a huge bear market, I think if you're going to pick some survivors, you'd probably lean more towards MicroStrategy. But that said, I think they've probably exhausted every form of financial product they could invent to try and generate yield and sell their share to. So that is somewhat worrying to me. Like, some of the timeframes and debt and that sort of thing, and they're just getting so complicated in what they're trying to sell to raise capital. It just seems like the risk is kind of growing there a bit, and I think they're basically desperate for yield, as we know, to sell yield, and we just saw the yield is at the lowest point ever, which that's probably worth tweeting about.
Why not piss a whole nother cohort of people off?
Just tag him in it.
So the whole business model, volatility helps short term being 3, 6, 12 months, right? If we get lots of vol, but does it help?
Doesn't solve anything.
If we're not getting a macro trend up of outperformance of Bitcoin against all other markets over the next 3, 4, 5 years, then this whole model doesn't work, because it's about leveraging traditional markets and getting a higher return in Bitcoin. So,
and I guess as a more of a cliffhanger question, without going into any depth, where are you diversified outside of crypto? What are other markets that you're invested in?
Yeah. So, first thing to note is for me personally, it's all in our fund. So all of my position is just in the Capriello fund, and we have a large weight in crypto and Bitcoin. So I'm still a believer in the asset class long term. But if you rewind a few years, it was 100% crypto, and that picture's definitely changed because there's other opportunities, I think, as well. And you can add a lot of, for me personally, diversification and better risk-adjusted returns if you allocate to some of those opportunities. So we have a decent Bitcoin position, which can be long or short. Very small allocation to altcoins sometimes, but there's none right now. And then for other asset classes, gold. Pretty significant position in gold the last few months. We didn't really talk about it, but there's a really good, I think it's a pretty good metric on our website. But the ratio of gold to stocks, and then if you kind of track that over 200-week moving average, for example, you can see the net outperformance of hard assets versus equities over the last 100 years. And every time gold is in that stage of outperformance, it doesn't always, but it tends to stick for months and years. And we entered that about a year ago. And it could end, now, or it could go for 5 or 10 years where gold just massively outperforms. And we saw that in the sort of 2000s for a decade, right, where gold just crushed equities. So as long as those conditions hold, that for me is a really strong reason to allocate to that asset class. And then equities, yeah, we apply some of our models to equities as well. For me, I'm most interested in us deploying those strategies in sectors which I think are somewhat like Bitcoin in terms of long-term outlook. So 5 years ago, 10 years ago, as you guys know too, I think you were a similar boat. It seemed obvious that Bitcoin was going to be the most massive outperformer in the long run and the best opportunity. And so I'm kind of trying to look for those sectors to apply similar logic to. One of them is quantum computing. Because the whole public listed quantum computing asset class is about 60 billion today, and that's global, and which is about the same size as Bitcoin 2016-17. And McKinsey is estimating a multi-trillion economic value within a decade. So, I see tons of volatility in bear markets like Bitcoin in that asset class that will happen. But I think if you zoom out 5-10 years, if you discount that forecast that these firms are giving back, you end up with sort of 50% higher annualized returns than Bitcoin will get if it goes to $1 million in the same time frame. So that for me is interesting. And then there's obviously other areas and parallels, some AI asset classes and different bits and pieces while we look at. But yeah, so probably rough split is probably about 40-50%. Or 50-60%. It varies in that range depending on the signals that we're getting in our models. But in sort of digital assets, 30%, 20-30% gold, and the rest in equities.
Yeah, awesome. Cool. Thanks so much for being open to share that as well. We're certainly, Sammy's just finished a report around quantum and AI based stocks and funds, indexes, etc. that we're considering. Because diversification into outperformance and forward looking is an important thing to do for yourself and for your investors, right?
Yeah, definitely.